Trouble is brewing. I'm your host, Steve Van Metre, and thanks for joining me today. Serious red flags are popping up all over the auto lending market, threatening both dealers and banks. Let's over to Bloomberg, where we picked today's story up with a headline: Wall Street warns of trouble brewing in auto loans as prices dip. Wells Fargo said that higher loan loss rates for loans that originated late last year contributed to an increase in write-offs for this period. Ally Financial, the country's second largest auto lender, saw charge-offs for retail auto loans quadruple in the third quarter. And Fifth Third Bancorp says pulling back on originations. And something I want you to understand here is the job of a bank is to manage risk. So when they lend money out, their job is to make sure they assess who they're lending it to get their money back. And what I want you to see here is that banks got this wrong. They thought the economy was going to boom as well, and what you're seeing here is them quietly start to admit that their processes failed, and that has massive implications. Used car prices slumped 7% in the third quarter, the worst decline since the depths of the global financial crisis, according to Manheim. The risk investors fear is that if consumers end up owing more than their cars are worth, they might stop making payments and let vehicles be repossessed. And this is a major fear for the banks because it is a likely outcome as consumers struggle with inflation and then eventually start to deal with job losses. They're going to look at what they're making payments on, what they have to make payments on, and what perhaps maybe they shouldn't make payments on anymore. And if they're upside down in their automobiles, you can bet there will be people that will turn in the keys, and the banks are going to be stuck with a dead asset. When Wells Fargo first started seeing signs of higher loan loss rates on loans that originated last year, the firm moved fast to tighten underwriting standards. The changes, combined with the impact of continued supply chain constraints, caused auto loan origination volumes to plummet 40% in the third quarter from a year earlier. So again, you note what's going on here with the banks. Hey, we made a mistake. We lent money out that possibly on an asset we shouldn't have, and perhaps to people we shouldn't have done either. And notice their response to this is they're going to tighten lending standards. So they're going to make it harder for people to get a loan. Now, what they're hoping will happen here is they will prioritize their customers to actually make payments on their loans rather than go out and get new loans. But that is a big response here because when you think about how money is created in our economy, it's created when banks lend. So when banks tighten standards, lending demand falls, and all of a sudden, the economy eventually starts to slow down. Used car prices jumped during the early days of the COVID-19 crisis, forcing borrowers who bought them to pay more and take out even bigger loans for those vehicles. Those customers are now reevaluating whether it's worth remaining current on their payments, something that could prove challenging for the auto finance sector going forward. And absolutely, this is an issue because what a lot of people don't realize is people borrowed money for their new car, but rolled over the loss on their old car into their new loan. Now, what I mean by that is when they traded in their old car, they may have had a balance. It could have been a several $1,000s or more, and they took that balance and rolled it into their new loan, meaning they were upside down even more on their new loan when they drove that car off the lot. Now, those cars are big time upside down. People are struggling to make the payments on them, and banks are faced with getting those cars back, and there's no way the banks will be able to get their money back on these bad loans. People, if they have a job, they will want to keep their car. They don't want to go buy a new one. They're doing a lot of things to keep their car and to stay current or work through with lenders. And that's true. And one of the issues we face here is there's $1.4 trillion in motor vehicle loans owned and securitized. So there's a lot of risk out there in the market. And I want you to note that the banks are kind of downplaying this, saying, hey, look, it's not a big deal. We'll get through this. We'll get our customers through this. We'll change the terms. We'll do some things to get through there. And yeah, we're going to get a few cars back, but don't worry, it won't be a big deal. But you'll see it is a much bigger deal than they want to admit. AutoNation, the nation's largest automotive dealership network, their CEO warns if used car prices drop as rising rates curb demand. And it's not just rising rates, it's a slowing economy. Mike Manley, who took over as CEO of AutoNation a year ago, said he's been aggressively turning over his portfolio of used cars to make sure he doesn't get stuck selling them for less than he paid. And this is an issue when you start to see disinflation or even outright deflation. There are places like car dealers that will get trapped. So they go out to wholesale auctions, or maybe they take lease returns and they buy the vehicle and then they need to sell it for a profit. But if prices are falling faster than they can actually turn those vehicles over, they'll end up losing money. And they're not in that business to do that. And so all of a sudden it changes the whole dynamic. They will stop selling cars because they don't want to lose money. Oh, and that will drive prices down even more. And so you can see they're hinting the problems are just starting to surface. In the used car market, it's just a matter of time before weaker prices at car auctions filter through the retail market, pressuring margins for dealers. So he's already telling you, look, hey, if you're out buying a car today, I got news for you. Prices are even coming down faster, and that will just lead to the greater likelihood that people sitting on these loans will likely end up walking away because they'll see the prices on the vehicle they own are much lower, and they'll hope that if they lose their job to later on get their job back and buy another vehicle at a much lower price. So you can see how this flows. Now, when we talk about the impact on inflation, now you might remember that used car prices were a big driver of inflation. Well, check this out. If what we're hearing is true, then that means car prices are likely to lead inflation down. And here we can see the consumer price index in blue, and then broken out from that in red, the consumer price index for used cars and trucks. And you can see it was a big contributor to inflation going higher. Now it's likely to be a contributor to disinflation going lower as we look ahead to tomorrow's inflation print. And auto loan delinquencies are rising as loan accommodation programs end. So government support, bank support is going away. And no surprise, people can't afford their cars. TransUnion, which tracks more than 81 million auto loans in the U.S., said Tuesday, the percentage of loans that are at least 60 days delinquent hit 1.65% in the third quarter, the highest rate for 60-day delinquencies in more than a decade, or since the last recession. So now things are finally getting worse than they were in the last decade. Since the last recession is telling us the overall health of the economy is far worse than the government and the statistics want to tell us. Something is rotten underneath, and it's just starting to surface. Consumers still want to stay current as best they can. It's just this inflationary environment is making it challenging. It leaves fewer dollars in their pocket to make their auto loan payment because they've got to pay more for eggs, milk, and other things. And the reality is consumers are going to prioritize three things above everything else. Their shelter or rent. They're going to prioritize food and energy, everything else behind that. So in this case, if shelter prices, food prices, energy prices are rising faster than wages, which we know they are, that means things like automobile loans, perhaps even credit card loans, are going to fall to the wayside, putting major pressure on lenders. And not only that, but of course the bondholders who bought all of these loans. If we get into a position where employment starts to be a challenge in the United States, which nobody thinks it will, and unemployment increases, this is when the industry will really start to be concerned about a consumer's ability to pay their auto loans. And they should be, because this headline from Insider, wave of layoffs has swept across American business in 2022. The cuts stem from slower business growth, obviously a weaker economy, and rising labor costs, and they're spanning across industries from mortgage lending to digital payment processing. And as we talked about yesterday show with Metre, now planning to cut more than 11,000 employees or 13% of its workforce, as Zuckerberg admits that he has to take accountability for his poor decisions, and the company plans to reduce headcount across its metaverse division, but said some teams like recruiting will also be impacted. So you can see, that is a huge impact on the labor market, and we've seen lots of other companies just trimming now, but those will have major impacts on those families. You think about those households who are now going to be out a job and what that means to their spending. But of course, it's the bond market, for particularly the auto lending bond market, that's saying, don't worry, nothing bad's going to happen. But I want you to remember, we heard that in the housing market before the global financial crisis. Subprime auto bonds hit by skip payments, falling used car values. But not to worry, these bonds were built to withstand relatively high losses. Again, a story you've heard before. For a median AAA portion of subprime auto ABS sold in 2022, the underlying loan pool would need to experience an annualized default rate of 78% over its life of the deal before investors would take a loss on their principal payment. Again, I'm trying not to laugh here, but if this doesn't sound familiar, to say, hey, don't worry, these mortgages can go bad, but don't worry, and so many of them would have to go bad that nobody's going to take a loss. And of course, what did we find out? That actually happened. But I want you to see this is the same rhetoric, but now in the subprime auto market and in that lending space, that there's $1 trillion of loans. Let's continue and check this out. It's hard for me to fathom a scenario, again, an impossible outcome where AAA rated subprime auto asset-backed securities experience a loss. For the double B rated tranches of 2022 subprime auto ABS, it would take a whopping 19% default rate over the life of the deal for the median bond to take a loss. For comparison, on subprime auto bonds during the great financial crisis, the peak average default rate was about 15%. So again, what they're saying is, look, it'll have to be worse than it was then. In reality, I think it is. What do you think? Is it going to be worse? Will auto loans be the trigger that causes the meltdown? Or are these going to skate through? With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.